Welcome to the Commercial Real Estate Podcast powered by First National. I am Adam Pawatic with Aaron Cameron at the second day of the Toronto Real Estate Forum. This is part of our speaker video series. We want to thank our sponsors, Dow Vukovic, ML Emporio Properties, and Turner and Townsend. Nurit Altman, Managing Director, RBC Capital Markets Real Estate Group, is our second guest of the day. She was a speaker yesterday, and now she's agreed to join us on the podcast, and we thank her for it. Welcome, Nurit.
Thank you for having me.
What's more pressure, speaking on the panel yesterday or speaking on the podcast today?
Oh, yesterday for sure. Yeah.
Wrong answer.
2,700 people or...
Oh, we got more listeners than that. I didn't tell you how many listeners we got.
So let's jump back to the beginning. How'd you get into real estate? How'd you get to where you are today? And then, segue into what does RBC Capital Markets do?
So my story starts when I was 18 years old. I graduated high school a year early, fast track through OAC and decided to defer my acceptance to McGill by a year because I wanted to go backpacking in Europe. And my dad was in real estate. He got me a couple interviews, and I ended up getting a job as Jamie Ziegel's assistant. He was running the investment team at Royal LePage Commercial at the time. And so I spent a few months there getting people coffee, photocopying. I helped plan the Christmas party. And generally, I would say I learned nothing about real estate, but really enjoyed the environment. Made enough money to go backpacking, did my BCom at McGill, and every summer would go back to LePage, which eventually became Cushman and Wakefield, because I thought it was a good summer job. I liked the people, I liked the vibe, but I wasn't all that exposed to much more than the photocopier. So the summer before my last year of school, I thought, well, I can't photocopy anything else. I need to use my brain. And I asked LePage if they would sponsor me in doing an independent study course with McGill. And Jamie was taking over the retail group at the time. And he said, can you help me figure out what we should do here? And so we did a whole study on the retail real estate industry in Canada and how LePage could grow that business, their retail leasing business primarily. And that was when the light bulb went off that, not just do I like the environment and like the people, but I like the business. And I thought it was one that I could build a career in. So when I graduated from McGill, I went back full time to implement some of the ideas that we came up with in the study, and did that for less than a year probably. When Jamie said, come over to the investment side, that's really where you're going to be able to, to build the career you want. And so did that with him for, again, maybe it was a year and a half before I was approached by Brookfield, who had just started Brookfield Financial, which was a boutique advisory firm. Working for Leonard Abramsky, who did retail investment sales. Now my expertise of 8 months and 1.5 years could be combined into a career. And I stayed there for 11.5 years. It was an incredible experience. It was a small team when I joined who was doing big deals. And I got exposed to so much, got to watch some of the best in the business, negotiate live, to be there sitting next to them while they had the tough discussions, watched what a pitch should look like, and just, got to see a lot of deal flow. And so I credit that organization and that experience so much with where I am today. But it changed over time. It became global. The senior leaders who I had such a strong connection with and who really, mentored me, many of them left. And it was just at that time that I was approached by RBC Capital Markets, who was thinking about succession planning in that group. And they said, would you like to come over? And we had partnered on a number of deals. And I knew it was the type of place that I would fit in. I knew that, we worked in the same way, very, high standards, high integrity. And so I made the leap, and that was about 5 years ago. So RBC Capital Markets Real Estate Group, does all the things that you think an investment bank would do in terms of raising equity and debt for public companies. We do debt advisory, but we have a large national property brokerage team. And the idea being, real estate companies can raise equity in the public markets, but a really important way that they raise equity is by selling assets. So we think it's part of a full service solution for our clients. So working with Leonard at Brookfield, much of my career was in selling retail real estate. Brookfield then started to sell a few of their office buildings, so got exposed to that. When I came over to RBC, what I saw was that we did not have a platform for the sale of multifamily outside of Quebec. Our team there was very strong, and I thought, why are we not doing this across the country? Because this is a time where multifamily is a very desirable asset class. So I took that on, and that's been a really exciting ride since I've been there. Went from never having sold an apartment building to, we just took bids on a portfolio of $500 million here in Toronto. So, and just, why do people hire us? It's because of the people and, because of a variety of relationships that I've built over the years. I'm now working on a number of industrial deals, which again is a first. But I think, it's really important to have asset class expertise, and that's what the team is for. But, having the trust, the relationships, and being an expert in how to run these processes, how to, tap the right capital, I think is why people hire us. So I've become, probably similar to your business, a bit of a generalist, working right now, active across the country, across asset classes, but really just trying to focus on deals that have liquidity.
Well, you didn't mention office, I guess, or that would become part of the equation.
Yeah. No, I've been fortunate to get to work on a number of really interesting office deals. I mean, what was it now? 2 years ago that we got to sell Royal Bank Plaza, where our head office is, for
That's
over
cool.
$1 billion. But yeah, office is challenging. I mean, everything is hard right now, but office is probably the hardest because, well, for a variety of reasons, but including the fact that it is so hard to get financing on an office deal today. And without the financing, the liquidity dries up even more than it already has.
So what is your favorite asset class? Just purely intellectual level, not liquidity availability.
She's gonna say hospitality or something like that. Yeah.
Well, I still love retail. Retail has my heart because I love shopping, and so I like the liquidity of selling apartment buildings. But touring an apartment building, you're in people's homes. There's a variety of things you might come across, but when you go to a shopping mall, you come across shoes,
a little more comfortable.
handbags,
A little bit more
things
comfortable. The site inspections are much easier to do.
It is the most complex asset class to underwrite. So I really believe that if you start out in retail, everything else is easy from there.
Well, which side of the street you're on can matter in a big way. For an apartment, it doesn't really matter so much.
You don't get percentage rents in apartments either.
No. But maybe, the way that the market's going, you never know.
Before we move on to sort of the fundamentals and what's going on in the marketplace, how big is your team?
We are about 30 across the country, but that's all different. That's our capital markets team, our debt advisory, and our brokerage team. I think brokerage alone would be about 18.
Okay. And you guys are active across the country?
We're active across the country. We have offices in Toronto, Montreal, and Calgary. And really, we cover the whole country, coast to coast, from those offices.
So how do you spend your time? Are you looking for new clients or just working with existing clients? Like, what's the vast majority of your time frame?
I would say it's a little bit of both. Interestingly, so I would say RBC Capital Markets, our focus is really our institutional clients, people who are in the business of investing in real estate and who are regular sellers of real estate as well. But, I can't say it was exactly strategic, although I have been working a lot with our private bankers and our enterprise strategic client group to get a better sight line and better access to the high net worth private clients. But it feels a bit coincidental or even demographic that suddenly there's a number of private families who are thinking about estate planning. The patriarch has passed. There's something that needs to change within the ownership structure. And so I'm working right now with a number of private families in the disposition of their real estate. And, it's different. You're not prospecting them all the time because these are families that once in a generation might sell, but just, like all of us, you have a network and you get connected with people. And when, there's a need, you're able to sort of access that. So I think, my day is always a combination of execution and prospecting and trying to figure out where are those pockets of liquidity. I mean, right now, obviously, always we're trying to find product, but right now it's almost about trying to find the money is the harder part of the equation.
What's harder to raise right now, debt or equity?
Depends on the asset class, I suppose, but I think equity. I mean, we work on a lot of big deals, and so typically we're working with well-capitalized groups who have deep banking relationships. And so, as you know, I would say maybe the terms are imperfect, the loan to value is imperfect, but you can usually find debt if you're a good borrower. But finding equity for big deals is really, really challenging. Getting someone comfortable and finding someone who has the confidence to say, now is the time to buy this piece of real estate. A lot of people will just say, why not just wait?
Wait 6 months, you'll get a better price.
Yeah.
You'll get bond yields down, whatever it is. Yeah.
And even if you don't get a better price, you will feel more comfortable in the decision because in theory, the environment will be less risky.
More certainty. We always talk about this, the amount of uncertainty in the marketplace. Last question on kind of your position, your last question on just kind of the environment you're working in. International, domestic. What's the splits on your sort of clientele?
Highly skewed to domestic. I mean, the Canadian real estate market is overcapitalized just with Canadian capital. So, we have these pension funds that punch above their weight class. We have right now not active in investments, but, a large public market with the REITs, lots of funds, so there's never a shortage of Canadians. And then you'll have a sprinkling of foreign. People love to hear that there's a foreign group who's, not your usual buyer. And I think there's a view that they'll pay more.
We'll thank Achilles for that. I mean, great company, great organization, but there was a period there 6 or 7 years ago where they were just coming in and buying everything at cap rates. Let's call it 50 basis points less than the domestic capital was willing to pay. And so it...
Well, do you remember Anbang?
What's that?
Anbang.
Anbang, yeah.
Again, a Chinese group that was willing to pay cap rates that no one else was. And so there's always that hope that you find that needle in the haystack, but 9 times out of 10, we're dealing with domestics.
At a more micro level, I was about an hour outside of Toronto and saw a billboard up by a realtor, and it's his arms spread out going, I have Toronto buyers. Same for them, the mythical Toronto buyer who will pay 2x market just because they got to live in fill in the blank small town. It's the dream.
So let's go to the fundamentals of the marketplace right now. It's sitting here at the Toronto Real Estate Forum near the end of the year. How's 2023 been for you?
It has been a lot of work for a limited result, is how I would put it. I mean, on one hand, I feel like our team is just firing on all cylinders, and I'm really proud of the deals we're working on, the clients that have put their trust in us. Like, there's a lot of great product that we've had the opportunity to represent, and that has been a great part of the year and rewarding in some way, but it is so frustrating. Trying to get a deal done today, it usually falls apart. If you can find a buyer and you have a willing seller at that price, then you put it under contract. The cost of debt changes 3 or 4 times throughout your due diligence process. You get renegotiated, it falls apart, you try to put it back together. So the deal cycle is so long and so often ends in no transaction. And so it's been frustrating. It's hard to kind of come in and stay motivated every day when that is the backdrop. But that's, I think, the beauty of being on a team. You kind of prop each other up, and when one person's having a down day, the other person can step in and help. But I feel, optimistic. The work is not for nothing. I feel optimistic that, we are heading into a period of time where transaction activity will pick up, I think. And all this work we're doing maybe makes for a great 2024 pipeline.
How often have you been getting, potential clients or clients come in and say, hey, I'm thinking about selling, and you go, okay, great, here's what we would recommend the selling price be, and they go, okay, never mind then?
What typically has happened is we say, this is what we think it would sell for, and they say, no, we would like a higher price, so please go to market and try to do that. So, maybe that's poor client management, but you do try to, help your client achieve their objectives. That's what we're here for. And even, we're probably taking on stuff that is lower probability in terms of hitting pricing targets, but I think, our job is to deliver the market right now. It's very difficult to give perfect advice on pricing, but for our clients, we will spend the time and do the work, go out and deliver them the market, and then they have a decision to make.
In our world, it's not dissimilar in a certain sense, where clients are showing to us and saying, I need a loan amount, I need a loan on my property, and our philosophy is, let's be honest, right? Let's tell them exactly what we are going to be able to provide. And so we'll say, okay, your loan's going to be 20 million, and they go, yeah, but lender A, lender B, lender C says it's going to be 24 million, and we go, well, I can't do that.
Maybe you should borrow from
yeah,
them.
particularly if everybody's using CMHC, and so you often have the same source of capital and the same ultimate underwriting parameters, and we're all going through the same process, and not dissimilar to you, we get the same buyer pool regardless of who's listing. We kind of say, okay, well, good luck getting that 24 million, and then of course, lo and behold, the client calls and goes, yeah, I got 20 million, just like you said. Does that happen in your world, where you've got other competitors saying, hey, I'll get you so much more than you think is actually possible? And how do you maintain your morale when you might actually lose a deal? All you have to do is throw a higher loan amount or higher,
because the deal will still happen.
Yeah.
The borrower or buyer in this case will be or vendor will be a little upset about the result, but they're still going to end up with a trade record going in favor.
I'm not the sales guy, Adam is, but often I'm sure you're losing business at times when you
being right and not paid is not, it's okay, but being right and paid would be better. But long term is better for your career to give the advice that's actually reflects.
You hope the next time they come back and they go, you were right, I'll trust you this time.
That's exactly how we look at it. We're in this for the long game, so give good advice, give the right advice. People remember. Even if they don't hire you, they remember that you gave good advice. And so we think that will pay dividends in the long run, even if it's very frustrating at the time.
Okay.
And you try your very best not to go, told you so.
Yeah. But everyone says that. Like, I'm sure if I had all of your competitors sitting here and I asked the exact same question, they'd all say the exact same thing. But somebody's always throwing out a number that's not reasonable.
There's one. I won't say who it is, but they're notorious for it. They're big. I will not say who it is, though.
But that's kind of the beauty of the market, and the reason why you have certain people willing to pay more for an asset than others. Like, sometimes we pitch something and we see something others don't, or we just have more conviction because of a recent deal we've done. So we're sometimes the ones who
throw the higher number
overshoot for whatever reason, but we do stand by. Like, what we never do is just overshoot to win the business. We stand behind what we put on paper, for better or for worse.
Yeah, because if you take the former approach, you're going to have a series of one-off clients who don't come back to you.
Well, the other thing is, worse than losing a deal is winning and then not transacting, because you're just wasting your time. Like, I could be on the beach and have the same result. So there's not a big win in taking something on that is unrealistic.
Yeah. How often are deals going to market and then just stalling right now?
A lot.
More than you've ever seen?
More than I've ever seen. I mean, I would say that our hit ratio when we, in a normal market, I would say it was be close to 90% of the deals that we took on would close. Today, it feels more like 50.
Will they come back? These are deals that will come back in 2025, or the promised land comes?
I hope so. I mean, we were in the market with a great retail asset in Vancouver. We just couldn't get to the pricing. And I just had a call from a client in our enterprise strategic client group who was in Asia. We sent her with the package. She's come back with a buyer, and we might be able to get something done. So that we launched in January, and here we sit, tomorrow's December. And finally, we might be able to kind of revive this thing. So I think that is my hope, is that that's what next year brings, is a lot of revival of work that we put in.
We're hearing a lot of whispers of a lot of off-market stuff going on, partly because those that are selling for good reasons don't want the reputational risk that they're selling and there might be a distressed sale going on. So there's, I think, legitimate off-market sales. And I think there are some distress situations occurring where they're trying to sort of reposition their structure or recapitalize to save themselves from whatever challenges they found themselves in. How do you play in that market? What's your role in that? And do you have a comment on that kind of
on the
whispers?
Yeah,
the whispers
well,
we're hearing.
What I would say is that, I mean, I have been so pleasantly surprised by the resilience of our industry and our market and how well capitalized people are, because we have not seen that much distress. Little bits here and there. But I would have expected, particularly, I would have thought developers, people sitting on land, they're
big. Holding on. Isn't it amazing?
They are holding on, and it's very impressive. So that's the good news. But we certainly are doing more off-market deals because, as I said earlier, the challenge right now is not getting your hands on product. It's finding a buyer. So you go, well, do we go to market, go through the whole, process of underwriting, putting a package together if we don't really have visibility on a buyer? Better that we go, chat with a few people, try to figure out who the buyer is and just deal directly with them. So it depends on the asset. I mean, industrial, I wouldn't recommend doing that because there is still a good bid for that asset class, similar in apartments, but perhaps if something is very large, perhaps if it's an office deal with a bit of hair on it, like there are situations where I think it makes more sense to just talk to a few groups and rather than doing a broad marketing campaign.
So to 2023 was tougher year, as you said. I'm sure you've been to the conference and heard the Survive to 25 over and over and over. In between 2023 and 2025, you of course have 2024. What's that going to look like for your team?
Listen, I'm an optimist, and I will admit, though, I have been wrong almost every day since about March 2020. It's funny because as I was walking in here, the guys standing over there with the digital platform were like, "Oh, you're in our video," and I recently watched that video that I recorded here last year, and how wrong I was in every prediction that I made. So take this all with a grain of salt, but. So in the last few weeks, we have a number of large listings, Vancouver Industrial, Toronto Apartments, Toronto Industrial, that we've taken bids on, $500 million, $300 million. And we have got probably $4 billion, if you add all these bids together, came in the last few weeks. Is the pricing perfect? No. But that's a lot of liquidity. And so I'm actually feeling quite encouraged that groups are out there with money and ready to put it to work. I'm hopeful that, we've seen the last interest rate hike. I don't know when, in my view, the next move by the Bank of Canada is a cut. I don't know when that will happen, but just the feeling that we're done moving up, I think will bring a lot of positivity to the market, and I think just take away a lot of the volatility, and hopefully that allows transactions to happen. So, I don't think next year is going to be a perfect year from a transaction volume perspective. I'm sure it's going to be back weighted, but I do feel that, things will start to flow. The real question is, where do cap rates go? Is it, do transactions start happening because rates fall through the floor and cap rates go back to where they were? I don't think so, but I think that stability, people being able to take a view, have conviction, will bring buyers and sellers together.
I'm a little worried because I agree with you, but you're telling me your track record is not great.
It's not great. But you know what? Better to be an optimist. I still take the optimistic
position.
That's
fair.
Classic sales, of course. Yeah. In previous, market disruptions, we'll call it, where transactions were put on pause, it did tend to, when they came back to market, come back with not a flood, but leap back up in volume. Do you see that for 2024? You mentioned back weighted. I fully agree with that. As soon as you have sort of stability in the market, do you think it will open the gates into late 2024, 2025, back to the real estate party we've all been accustomed to?
I would love to say yes, and I was just talking about how optimistic I was, but I think there's going to be a bit of PTSD from this experience. It's going to take some time for investors to trust, even if we are in a period of stability, even if there is a rate cut, to trust that the trajectory is going to continue in a way that they predicted it would, because the last 18 months has certainly not been that. I think there's been a lot of surprises. And so my view is that there's going to be more caution, people dipping their toe rather than diving back in. That will be 2024. And I think that by 2025, we'll maybe get back to a more normalized market. I'm hoping that, the party that we saw because interest rates were near zero is not one that we see again, because that was because we were in crisis. I'm just hoping for normal.
Yeah, we don't want 1.5% interest rates on.
Yeah,
on
I think
because I'd rather not have another stay-at-home order.
Yeah, geez, yeah, don't mention it. I think the hope, as you say, the optimistic hope is that it's this consistent band. There's some certainty. Rates are going to stay in this nice band. Everything's going to be stable going forwards. I mean, there's obviously going to be noise around it, but if the cost of capital can be consistent, and we can start making decisions and start projecting our costs going forwards, I think that helps a lot of people.
I do think there is such positive tailwinds for the real estate industry in Canada. I mean, population growth fills our office buildings, it fills our apartment buildings. It means people are going to the mall to shop. And so in the long run, there is going to be a huge amount of capital being put to work in the real estate space. Over what period of time, though, does it come flooding back? That I'm not sure I have perfect visibility on.
So no froth in 2025, but maybe
no froth, but maybe us brokers can make a living.
Great. Well, out of time, unfortunately. I'd like to thank First National for powering the podcast. Thanks to the Informa for hosting us here at the Real Estate Forums, and our sponsors of the speaker video series, Dow Vukovic, ML Emporio, Turner and Townsend. And of course, thanks Nurit for coming back on. Really appreciate it.
Thank you so much for having me.